I've been trading Forex for 14 years, and for the last 5 years, I've been trading a Bollinger Band strategy. And in this video, I will show you how to do a multi-time frame analysis and how to combine price action with Bollinger Bands and how to get into trades. It is Tuesday, it is Tradeciety Tuesday, so welcome to a new video, and also make sure to check the link in the video description below to our new podcast episode which just dropped today. So I want to get into a Bollinger Band strategy where we also use multi-time frame analysis and also a price action filter or add-on. So when we trade any trading strategy, we always want to combine the higher and the lower time frames. On the higher time frames, as I will show you in a bit, we are determining, are we going to look for long entries, are we going to look for short entries, or are we not doing anything? And then once we have done that, we drop to a lower time frame, and on the lower time frame we time our trades. On the lower time frames we find our entries, the exits, we place our stops and the targets. And this is generally how to go about it. So here what I've prepared is we are on the higher time frame. This is the daily chart, as you can see here. And what we are using is a 20 period Bollinger Band with 2 standard deviations. Very basic, it's the default setting and it works very well. Also, I have used the 50 period moving average from the next higher time frame, which is the weekly. And we are starting with the weekly moving average because it's the simplest rule. If the price is above the moving average, you are generally looking for long entries into the trend direction because we want to trade with the trend. And when you look at just at this example, here is where the price has crossed above the moving average. The price action into the bullish direction, those are the big moves, those are the smooth moves. Here and here, 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 and so on and so forth. On the downside, if we are looking for shorts, those are usually the moves that struggle. They don't go as long and they're not as smooth. So really important, we only trade into the direction of the higher time frame moving average. Then second, the Bollinger Bands help us to time pullbacks. So we want to trade long and we want to trade for the lowest possible price, because obviously if you want to buy, you want to wait until the price is at its lowest. That is the best opportunity and the best time to buy. And we are using the Bollinger Bands and we're waiting for the price to get outside of the Bollinger Bands. I don't want to get into the statistics too much, but the only thing we need to know is that if we are looking at 2 standard deviations based on statistics, it means that 95% of the price action has to happen within the Bollinger Bands. Only 5% of the price action can happen outside of the Bollinger Bands. Bollinger Bands are volatility based and they are using standard deviations and they automatically adjust to the price action. When the price action is very strong and very volatile or not, the markets and the Bollinger Bands will automatically adjust, which makes them a very great indicator because they're not as lagging and they're always adjusting to real-time price action. So we want to wait for the market to push outside of the Bollinger Bands and then in the next candle close back inside of the Bollinger Bands. That's really important. Just because you can see here, just because the market is outside of the Bollinger Bands, that's not enough. We want to wait until the market is back inside of the Bollinger Bands. That's really the key. That is very important because it will help us filter out those big trends and those big trends. And we want to stay away from that. So we want to be long, and we only want to be long when the market is coming back and outside of it. And then the Bollinger Bands work like a rubber band. The market is outside of the Bollinger Bands and then it will snap back inside. This is a very, very common thing. So let's go to the lower time frames. And I marked here 4 scenarios that I want to analyze on the lower time frames together with you so that we can find trade entries, and I will show you how to do that. So 1, 2, 3 until 4. Here is point 1. This is the first point that the market dropped outside of the Bollinger Bands. And again, we are looking for long opportunities. And on the lower time frames, if you use, for example, an RSI indicator, you will have a massive divergence in here. Also, in Wyckoff analysis, this is what we call a spring pattern. Some people may refer to it as a trap or simply a fake breakout. So the market is in a short-term, lower time frame downtrend. And we want to look for when is the lower time frame downtrend over. And the divergence, the fake breakout, is a very good first indication. And also we have a very strong resistance level here. And we want to make sure that the market is breaking above it. And then we have two options, as I indicated in my last video, where I talked about what is better, breakouts or pullbacks, how do you trade them. I will also link it in the video description, so make sure to check that out. And then you have two options. Either you trade the breakout or you wait for the market to pull back. And those are then your long entries into the trend direction rather. And this is what happens afterwards. You can see you have a strong breakout, the market came back, retested the area, and then took off. So this is how you time your trades, higher time frame to lower time frame. Now let's go to point number 2 and examine it on the lower time frame. Here we are at point number 2. Again, if you have an RSI divergence, you're gonna have a divergence. Clearly the trend is losing strength here in a short period. The market fell very strongly, and then here not as much. You have a very strong flip zone, so support turns into resistance. You have what I call a lower bounce or a breakout buildup, and now you want to wait for the market to break above it. This means that the market is now making a higher high, which is essential for a new uptrend. And this is then what happens. You can see the market broke out, moved into the direction, and if you have maybe missed this opportunity, or maybe you're just looking for a second trade entry, then here we have a retest, and then you can see the market moved again into the trend direction of the lower time frame. So now we're looking at point number 3. Here, strong move outside of the Bollinger Bands, and here we are on the lower time frame, and you can see the market dipped lower. We have a flip zone of divergence here, break and retest. Not always will you be able to trade them on the lower time frame. Sometimes the move on the higher time frame, the move outside and back inside, are going to happen very, very quickly. So not always will they actually be tradable. So point 4, this is my bad. This is point 4, but it doesn't really matter. But I wanted to highlight this specific situation here, because here we have two things that are coming together. We have a move outside of the Bollinger Bands, and also a move into the higher time frame moving average. So two very important things coming together here. And let's look at the lower time frame in this example. So here we have the lower time frame. It's hitting the long-term moving average. Again, you have a divergence here. You already have a higher low, which is important. You have your previous high. You make higher highs, you make higher lows here. So you have a breakout and a pullback. And here you can, obviously this happens much more rarely, that you are also having a move into the higher time frame moving average, especially the weekly. It is not as tested as often, obviously, because it's a very high moving average on a very high time frame. So it happens rarely, but if it happens, there can be even better signals. Here I have also picked the Aussie Canadian on the daily time frame, and I marked all the times that the price was dipped outside of the Bollinger Band. So again, the price is above the weekly moving average here, the 50, and you can see here it's outside, and here, here as well, and here twice. Here obviously as well, I missed that, but you can see we have very nice rejections. Obviously, nothing works 100% of the time. However, this trading approach is very, very accurate. And again, some snaps and moves outside will be much harder to trade, such as here the market dipped out and then within the next candle shot up very high. So on the lower time frames, you probably will not find an entry. But if you see things like this here, where you have a doji and here as well a doji, or just a pin bar, those are very great trading opportunities. And you can use this on any time frame. You can use this, the daily can be your higher time frame, the 4-hour can be a higher time frame, the weekly can be your higher time frame. You can use it on stocks, on forex, on commodities, on all markets, and it is a great way of how you can integrate higher time frame analysis, higher time frame trend analysis, together with lower time frame trade execution, momentum divergences, price action, trend lines, you name it. You can build a very robust and great trading approach using a few handful of high probability scenarios. So let me know what you think in the comments below. Did you enjoy this? Do you like more of that? Leave a comment, leave a thumbs up. And don't forget, next Tuesday is Trade Society Tuesday once again, and I will have a new video for you.